Hello, all. We want to talk about gross income. You all filled out, tax forms, and you saw where your wages and salaries. You put it at the first, place, and then if you had any bonuses, you had to write on that form. If you received interests, you had to, write on that tax form. And there are other expenses. If divorced, alimony received. Therefore, business farm income, if you have a business and you have some income from it, you write it on that form. You have some assets, let's say building, you sell the building, you have to write a gains. That means you bought it for 100,000, you sold it for 150,000. Therefore, that's, a sale of assets. And then income from pensions and annuities. What are the pensions and annuities? Let's say when you are retiring, you work for the state of West Virginia, for example, for 30 years, and then the state of West Virginia might have some retirement. Some companies have. These days they have less, because we have 401ks, we have less pensions. Let's say you are working for Ford Motor Company. Ford Motor Company creates some income, some retirement account for you and put some money in it every, month or every year. When you retire, you will have some income, just like Social Security check. Some income comes from some employers, but these pensions are disappearing. That less and less companies, giving pensions, because they say, oh, they are giving 401ks, and therefore they don't want to lose as much money. Annuities is when you put the money in, you give it to an insurance company. You have $100,000 and you say, okay, I am 70 years old and I give you $100,000, and for the next 10 years, you give this $100,000 back to me. And each year, the insurance company has to pay you 10,000 at least. 10,000 for 10 years is 100,000. Also, in addition to that, of course, it has to give you interest as well. Therefore, sometimes the interests are a little higher. We already talked about a 5% interest on money markets. But these annuities, they come and say, okay, we will give you, you give us your 10,000, 100,000. In the next 10 years, we are going to give you 10,000 plus an interest on top of that, and that interest better be more than 5%, maybe 7%. Why not? If I have $10,000, I am 70 years old, and I want to be safe. I want to make sure I have income for the next 10 years. I give my $10,000, $100,000 to an insurance company, sign a contract, which is called annuity. And then what I do in the next 10 years, I know that every year I'm going to get $10,000 plus 7% interest. That means the first year, 10,000, 100,000, 7% of 100,000 is $7,000, which is not a bad thing. That means during the first year, it gives me $17,000. When it comes to the second year, that means my 10,000, 100,000, $10,000 of it is gone. That means I have $9,000. Then it gives me $10,000 on it on the second year. And because I had 9,000, and then 6,300 are the interest of that 9,000. It adds it to that $10,000. In the second year, I have 16,300. On the third year, I will have $1,500, and it goes. When it comes to the final year, it gives me a check for maybe 10,000. $100, $200. Do you see that? $700. Therefore, those are called annuities. Annuities can be a lifetime annuity. I can go and sign a contract with an insurance company and say, I give you 100,000. I am 170 years old. And the insurance company is smart. They say, okay, we get your $100,000, and for the rest of your life, we are going to give you something. And of course, they are smart. They are not going to give me $10,000 a year. You know why? Because this $100,000, I might live up to age of 100. If I live up to age of 100, that, insurance company knows about these things. Actuary science are the one, is the science that calculates, how the payments should be, and, possibility of myself living up to age 100. Therefore, they get my $100,000, but this time, instead of giving me $10,000 every year, because it is a lifetime annuity, It gives me, let's say, $500 until they say, as long as I am alive, it's going to give me $500, or maybe, of course, 100,000, because more than 500, most likely, because they estimate, they say this person isn't going to live usually until age 90. Therefore, if you distribute 100,000 to age of 90, that means that 20 years I am going to live, 20 more years. These 20 more years, that means if they give me $5,000 every year, after 20 years, these $100,000 are all, spent on me, are given back to me. However, I'm not crazy to give them just 100,000 because they give me 5,000 every year, because I can put it in the bank and get $5,000 myself. I give it to the insurance company and tell the insurance company, okay, I give you $100,000. Let's sign a contract. As long as I am alive, give me that, something around maybe $7,000 a year. Do you see that? Or 6,000, 7,000. The insurance company says, okay, as long as you live, we give you 7,000. I give my $100,000 to them. And then I am, now that I gave my money, of course, these are valid insurance, solid insurance companies, Therefore, I am happy that as long as I live, I know that I have $700 coming to me. Now, the insurance company might lose if I live up, over 90 years old. Do you see that? However, if I live less than 90 years or 90 years, the insurance company will gain. But this is more, and I don't call it a gamble because it's insurance for me. Annuity is a kind of insurance for me that I feel that if I give them 100,000, I have until the rest of my life, I have 700. I add that $700 to the Social Security that I have. Imagine I get $1,300 Social Security. If $7,000 added to 30, let's say $13,000 a year, I get Social Security. 7,000 is added. Then in my retirement, I know that I have at least $20,000 a year. The issue with the annuity, the problem would be, is that if they give me $7,000 for the rest of my year, my life, the 7,000 these days might be a good amount of money. But when I become 90 years old, they give me 7,000. 20 years down the road, 7,000 is not as much as what it is today, because the money, things become more expensive, inflation, Therefore, annuities are good. Let's not forget they are not bad. It gives some assurance. For some people, annuities are good. For some are not bad. We will learn more about them. Just I want you to know what, pensions, we already talked about pensions. We talked about annuities. And these days, your employers, as I said, if you work, many of you have heard of 401k, 403b, and those are also retirement accounts that, give some income. And then usually the younger people don't have as much from pensions and annuities. Retired people and, elderlies have those income. Income from rent and partnerships. Therefore, you have properties. These are the income. Prizes, lotteries, and gambling. Therefore, when you gamble, you make some money. You have to pay taxes on those as well. Therefore, you add all of this together, that becomes gross income. In the form that you filled out, all of you filled out, it was a simple form. You declared only two incomes. One of them was wages and salaries, and one of them was interest. You remember 500, some people put, and dividends are the interest. They are like interest when someone has a stock. Let's say if you have a stock of, for example, Costco or Walmart. Every quarter, if you have one share of Walmart, which is around $200 each share, maybe every quarter Walmart deposits 25 cents in your account for owning a share of Walmart. 20 cents, is not significant amount of money, 20 cents, 15 cents, But if you have thousands of shares or millions of shares, of course, those 15 cents add up. But anyhow, we want you to know what we mean by gross income. You already saw the form. We come here, and in addition, there are other, things, and we come here, capital gain. Capital gain is when you have, for example, a rental property or real estate. You see that you have a real estate here, and you bought a property, rental property, for $100,000. You sold it for $150,000, for example. Then you make $50,000 on it, assuming that all the expenses or everything calculated. Therefore, if you have sold your property and you make $50,000, you have had a capital gain, and that is $50,000 of capital gain. You have to pay taxes on it. And therefore, state tax, West Virginia wants a portion of it, federal government wants a portion of that $50,000, and that is, something. There is something also here, I saw an interesting about the people who have a house and sell. Do you see? Imagine that if you have a house, you buy your house for $100,000, and the house becomes $350,000. That means you make $250,000 on the house that you paid, because $100,000, then now it is $350,000. That means your house has gone $250,000. Now you come and say, oh, should you pay taxes on this $250,000 or not? The thing is that the IRS is very nice to you. It comes and tells you that if you leave that house, you bought that house to live in it, and because it was your residence for a certain years, let's say 2 to 5 years, then they come and tell you, okay, you don't need to pay taxes on up to $250,000. Therefore, if you sell your house for, let's say, $400,000, you bought it for $100,000. Yeah, and then the government is going to forgive out of, that means when you sell it for $400,000, you bought it $100,000, you sold it for $400,000, you make $300,000. Out of $300,000, $250,000 of it, you won't pay any taxes on it. All you have to do is for the remaining, which is only $50,000, you pay $50,000 taxes. That's for individual. If you are married, then the government is going to give a good break on you, and up to $500,000, if your house is increased, its value has increased, as the value is increased, it is going to give you it is not going to charge you for up to $500,000 of taxes on that property. Therefore, we want you to become familiar with this gross income concepts and know what is involved. And hopefully you understood pensions and annuities and also gambling. You go to Las Vegas and you will win, $1,000. Although the IRS might not find out that you won $1,000, but the legal way is that you go there and you report that, or you made $1,000, and most likely you have to pay, I don't know how much, $100 the IRS wants from it. And maybe the state of West Virginia, you have to declare it. You win a lottery, and you know that there are huge taxes on lotteries, and you get some prizes that you are going to get. I think the scholarship you are getting doesn't fall in this category. Do you see that? It doesn't, because a scholarship is, the money that comes to you. Maybe that's, not part of this. Therefore, this is something we want you to do. And let me go to the next page while I am lecturing here in adjustment to, gross income. When you add all that income that we already talked, suddenly your salary goes and it shows as $100,000 you had income, for example. That's a lot of money. Some you are hoping maybe you had some deductions. That way your salary, you don't pay taxes to the IRS on $100,000. Because think about it, if you make $100,000, the IRS wants $20,000 of it. You have to find some ways, legal ways, not to give the IRS those $20,000. If it is legal, why not? What can we do to reduce our income in such a way that instead of $100,000, we show on that paper that we had some expenses, some legal expenses, that your income, drops. Let's see what you can do. Educator expenses. If you are, it's a limited. Let's say if you are a teacher, I think some teachers have some benefits, say if you are a school teacher, suddenly the federal government says, if you make $100,000, we are not going to charge you taxes on 100,000. We are going to charge you, taxes on 95,000. Do you see that? Therefore, educator expenses, you can use, Google, Chat GPT, see what educator expenses are. I can put later on Chat GPT to tell us. Higher education costs, including tuition fees, boardroom boardroom, personal expenses, room and board don't qualify. Therefore, certain higher education, are tax deductible. Therefore, if your income was $100,000, $5,000 of it went because you were a teacher, but at the same time you took some classes or something, and that included some fees and those things. That is, tax. IRA contributions. Many students know what it is, and many do not know what it is. Extremely important. We are going to spend a lot of time talking about IRA, Roth IRA, which stands for Individual Retirement Account. This is the money that very important. You put in this account for your retirement. We will have a lot of time, which we are going to get into every detail of the IRA and 401k. But that's, again, you put 5,000 limited. That means that you cannot put as much as you want. You deducted $5,000 here from your $100,000. You came and said you had expenses for education, and that was $5,000. You put another $5,000 for IRA. So far, 5,000 is 20,000. That means that instead of paying taxes on $100,000, you deduct 20,000. You tell the IRS to deduct taxes on 80,000. Do you see that? You are showing your income, lowering your income that way legally to pay less taxes. Self-employment paid taxes limited 50% of the amount paid. Therefore, you are the one that you are self-employed, you have your own business, and you are employing. Therefore, that is taxes paid, which means you already paid some taxes. Self-employed health insurance payments. Therefore, these self-insurance payments are tax deductible. And then there are other things. After you deduct all of those, that is adjustable gross income. This is what you did, and you calculated as adjustable gross income in that term, 1040. I am going to stop this video because I don't want to become a very long video, but I want you to, understand about this. I put another lecture, but it's important you understand this thing.